own 81 properties and 4 apartment buildings.
How much, have you had any life insurance?
On me, no. I don't.
The big danger is you have $40 million in real estate, you have $30 million in mortgages, and no life insurance.
I think I'm good, because it's all in the LLC name.
You've protected everything else but you. What you just watched is a real conversation. I was on my Keep the Keys book tour across the country, and I was sitting down with real people in real situations beforehand. I met this man along the way. He owns 81 rental properties and 4 apartment buildings. About $40 million in real estate, and he's been doing this since 1999. And we were actually comparing notes because I started my insurance career in 1999. Here's the thing though, he had 0 life insurance on himself. And that conversation right there is the gap that takes families down. Everything he built, everything he sacrificed for is sitting on one heartbeat with no protection around it. Now, before I get into it, think about this. Before that man closed on a single one of those 81 properties, the bank required insurance. Before he drove a car off the lot and he financed that car, the lender demanded insurance. You see, banks protect their collateral every single time. They force you to cover what they're owed money on before the ink dries. But this man himself, the engine running the whole operation, he's procrastinating. And here's the truth about procrastination on this specific decision, that every year you wait, the cost goes up. Actually, I told him that, he didn't believe it. Every birthday that passes, if you didn't know, the premium increases because you're getting older. And the day your health changes, that window starts to close permanently. You don't get a second chance to lock in what you could have locked in yesterday. The banks protect their loan, but nobody forces you to protect yourself. The gap right there is what costs families everything. And I'm not the only one talking about this right now. If you own property and you want to protect what you've built, you're in the right place. I'm a United States Marine Corps veteran, author of Keep the Keys, and I've served over 122,000 families and built an agency of more than 5,000 agents across the country. I've been in this business since the dot-com crash of 2009, the Great Recession of 2007 to 2009, the global pandemic of 2020. 3 of the worst economic periods in modern history in our lifetimes, and through every single one of those, I've watched real estate investors make the same critical mistake. Now, the Keep the Key strategies were born from these economic times. So let's get into it. Graham Stephan just announced he's selling his entire real estate portfolio.
I have a refrigerator worth $500. The ice maker goes out, and I get a bill from the property manager for $900.
Yeah.
Why? Well, they said, oh, the ice maker went out, and the tenant called. And so we had someone come out and they said, oh, the little valve behind the refrigerator's leaking a little bit, but they couldn't just buy it from Home Depot. It was a special order valve. By the time it's done, I spent $900 to keep a $600 refrigerator alive. That pissed me off. Why would you spend more than what the refrigerator's worth? It's stupid stuff like that. I don't want to think about it anymore.
See, $900 for a $600 refrigerator. But you see, it's not the fridge. It's the unclogging the toilet at 2 o'clock in the morning because the tenant called in. Now it's your problem. It's the tenant who hasn't paid rent in 3 months, destroying your property, and still has the nerve to ask for their security deposit back. Meanwhile, your mortgage is still due. And guess who's paying it? You are, because you're the landlord. Your property taxes are still due. Your upkeep doesn't stop for anybody, regardless if they pay rent or not. You see, buy and hold is a long game. Decades of buying and holding. Sure, that creates wealth. And when your YouTube channel is generating more income than all your properties combined, the math tends to change very quickly. That's the honest truth about where Graham and Caleb are. They're just not tired of low returns. They're tired of the work.
What's a financial mistake that you make?
My rental properties, I'm exiting them.
Are you losing money on your house? When you sell it,
When I sell it, it'll be break even. At best, maybe a little loss, but I would have made so much more money being in the market.
Sell those things as soon as possible.
I am. My rental properties back in my home state. Yeah, I'm fully exiting them and I'm just putting the money in the market. So that was a financial mistake. You don't need to buy a house to be financially successful.
Break even at best. See, 2 smart people, in my opinion, making the right call for their situation, but neither of them finished the thought. What happens to Caleb if he can't work tomorrow? Rental properties are gone. Money's in the market. One health event away from the same crisis he was trying to exit. You see, they solved the real estate problem. They left the protection problem sitting on the table. And then there's Mr. BRRRR. This guy named himself after real estate strategy. He built his whole brand on it. Do you know what the algorithm is now serving me from his account? And I don't even follow him. Yes, life insurance, infinite banking, how to become your own bank, whole life insurance, index universal life insurance. Now, I don't think he left real estate. I don't follow his account, but I don't think he left real estate. He just found out what real estate alone was missing.
The wealthiest individuals use life insurance, the Rothschilds, the Rockefellers. There's a reason the Rockefeller family has become wealthier and wealthier and wealthier over 9 generations. They know without a doubt you're gonna die. Yep. They just don't know when. This is why I love life insurance, literally, because it's a mutually owned company. You own a fraction of the company.
Now, I've watched this rotation start in 2005. My first training in life insurance and real estate equity strategies began that year. A man named Douglas Andrew was in front of the room, New York Times best-selling author at that time, Missed Fortune. The originator, in my opinion, of the equity repositioning strategy that became the foundation of everything that I teach today. A man who still stands in rooms with my team right now. I'm so glad of our relationship the last 20 plus years. More than 100 people in 2005 were in that room. Yet more than half were real estate agents and loan officers selling mortgages. They're not there for insurance. They were there because they saw the same gap Doug Andrew was pointing at. Everyone I can name from that list, I still got a roster of everybody in that room either is completely out of the real estate business today, out of the mortgage business today, and guess what industry they're in? They're in the life insurance and retirement planning wealth management industry. See, Graham didn't have a YouTube channel yet. Caleb, I believe, was 10 years old. Mr BRRRR was just years away from branding himself after strategy. And Douglas Andrew was already in front of a room full of real estate professionals telling them exactly what's happening right now. See, the faces change, but this pattern doesn't. And I've seen it now for over a quarter century.
Remember the 4% you're paying for the 6% you're earning. That pile of cash grows too. Remember
20 years earlier.
Yeah. It's growing too.
Something different now. It clicked.
Yeah.
It clicked. It's clicking.
Yeah.
You're leveraging money versus leveraging equity.
You see, that moment was real. This man has been doing this since 1999, survived all 3 crashes, not easily moved, and you watched him do the math in real time. Pay 4% on a mortgage, redirect that capital somewhere earning 6% or more. That's called arbitrage. Now you're up 2%, compounding on a base that's been growing for years ahead of where you'd be if you waited. And you still own the property. But think about this. He owns 81 properties, 4 apartment buildings totaling over approximately $40 million. $180,000 a month in rental income coming in. But every outside measure, he is winning. Yet, no life insurance. Yet, no trust. Yet, his entire empire is sitting on one heartbeat. And when I asked him about it, you know what he just said?
I think I'm good because it's all in the LLC thing.
Bro, the LLC doesn't feel a stroke. He is the engine, and when the engine stops, the whole thing stops. Now, let me ask you something nobody asks at the closing table. What does his wife do when she inherits that portfolio and he's long gone? Does she have the relationships he spent 26 years building? Does she know which property manager actually shows up and which one ghosts her? Does she know what a cap rate is? Does she know what contractor does electrical and which one only touches plumbing? Does she know which tenants pay on the first and which one she needs to call by the third? No. You know who she's calling? She's calling a realtor, selling everything as fast as she can. Not strategically either. Not at the right price. Fire selling it as fast as she can because she's grieving and overwhelmed and nobody left her a roadmap. See, that's not a legacy. Brother, that's a liquidation sale. And here's what breaks my heart about that picture. He spent 26 years building something real, something that works. And with the right keep the key strategies in place, that same money could be doing 2, 3, 4 jobs for him simultaneously. Number 1, death benefit that keeps his wife from making that panicked call to a realtor. 2, living benefits that pay him through a stroke, a heart attack, or a cancer diagnosis before the game is over. 3, accessible cash value he can pull at any time to buy the next property, expand his real estate empire, fund the next business, or seize the next deal without a bank, because he's the bank, without a credit check, because he's got his own FICO credit score, without asking for permission. You see, the same dollar protecting his family, protecting his income, and building a liquid war chest he can easily deploy when the right opportunity shows up. See, that's not insurance. I call that a financial command center. Real estate investors who understand this don't wait on a bank to say yes. They are the bank. They already have the capital sitting there, easy as a phone call and an EFT transfer. That money, meanwhile, is compounding and more so waiting. That is keep the keys. Now multiply that by every investor watching this in a market that just shifted underneath them. For example, right here in North Dallas, Collin County, Frisco, Prosper, Salina, home prices dropped nearly 9% in a single year. 1 in 5 active Dallas listings already has a price cut. And National Association of Realtors, NAR, their own 2025 data shows that 71% of licensed real estate agents in America close 0 transactions. 0. 86% close 4 or fewer deals in an entire year. See, that's not a slow market. That is a profession in crisis. Every realtor and loan officer watching this, the keep the key strategies keep you a reason to stay in front of your client's face long after the transaction of buying their property closes. Now, you help them get it. Now help them keep it. That's how you become a lifelong advisor instead of the real estate agent who just showed up at closing and disappeared. In a market where 71% of agents closed nothing last year, that distinction is the difference between staying in the game and becoming a statistic. 3 problems that keep the key strategies solved that real estate alone never will. Number 1, liquidity. See, equity is not cash. You can't eat bricks, especially when your income stops and you can't call your lender and request it. You sell, you refinance, or borrow. That takes time, that takes cost, and the bank's permission for your own money. In a health crisis, you don't have any one of those. Now, a properly structured index universal life gives you access through policy loans. No bank, no credit check. Your money keeps compounding while you're using it. Now, run everything through a test I call the Clarity Test, which stands for control, liquidity, access cost, rate of return, insurance benefit, tax advantages, and yield safety. If your money fails that test, it's not a strategy, it's a liability. You got better quality questions to ask. Number 2, protection of the operator. That's you. Living benefits inside a modern life insurance contract pay you a portion of your death benefit while you're still alive after a critical illness, or heart attack, stroke, cancer. Guys, I just got a text. One of my agents says, "Hey, Matt, do you remember so-and-so and so-and-so?" I said, "I do." She says, "Well, they just had a living benefits claim approved. They're paying $34 a month for a 20-year term policy for an $800,000 death benefit. She got the policy when she was 27 years old and paid around $2,100 total for the last several years. She doesn't even have a diagnosis. She's been to every doctor in the Midwest the last few years. She'll get $51,000 and still have $600,000 death benefit to file again on next year if she needs it. Why? This young lady has an issue with a feeding tube, and she's now in her 30s, and they can't find a reason why she is not put together all the way 100% yet. So this is a living benefit claim. She owns property. She owns responsibilities. You see, this is not death money, survival money. This is real life that this life insurance policy pays while she's still living. Number 3, legacy without a forced sale. One year, we placed a $23 million policy inside an irrevocable life insurance trust for a client with $20 million in estimated estate tax exposure. This was funded by just simply repositioning $2 million from a savings account into a life insurance policy earning less than 1% from that former savings account. He sold nothing, and his family is keeping everything when the worst case scenario happens. You see, in a market where North Dallas is seeing a 9% correction and forced sellers are everywhere, the family with the trust and the policy holds. The one without it takes whatever offer comes first. 2 things before we close now. I'm on Connect. Book a one-on-one with me directly. Link in the description. You've got questions about your retirement account, your real estate strategy. You bring your numbers. We go deep. And if you're in the Dallas area, I host an event called Cigars, Wealth, and Whiskey Quarterly. The next one is August 20th right here in Frisco, which is an upscale masterclass. My topic, Mastering Power Partnerships. Now, we're going to have real-minded conversations with serious people going to this room. Go to my website here or scan the QR code to buy your ticket for the next date. Now, in my book, Keep the Keys, I got 8 chapters that walk you from the equity illusion all the way to the liquidity legacy plan. Everything we covered today is in there with the full strategy behind it. Now, 2 types of people are watching this right now. If you're a property owner, investor, realtor, or loan officer who wants to bring these strategies to your portfolio or your clients after the transaction is done, comment plan in the comment below. We'll connect you and we'll help close the gap. If you've been watching what I'm building and you know there's a better way to generate income without tenants, without mortgages, without the overhead, comment movement in the comment section below. We are building something serious and we want serious people in it. Now, if you got value from this episode, please hit like. And if you haven't already, hit subscribe and notifications to be alerted the next time we upload our next episode. And please drop your biggest takeaways in the comment section below. I appreciate y'all for watching. God bless you. And until we meet again, continue to live smart, continue to love smart, and be money smart today.